Good day, fellow South African students. Welcome again in our Hello Smart Learning Camp sponsored by VT Africa Holdings. I hope you enjoyed your weekend. I hope that you studied and you're preparing for your exams. However, these lessons will help you also to prepare that you may pass accounting, and also they might benefit you if you take them serious. Don't forget that to participate in this program, you have to go to this website, www.hellosmart.com, and sign up as a guest. Just create a new clean name, and your ID number will be 598751. I'll repeat that again. Just go to your website, www.hellosmart.com, sign up as a guest, add a new name, and use this ID number that is 598751. Okay, thanks. So for today, we'll recap on what we were talking about last week. Remember, we are talking about corporate governance. And as I asked you that these things are very important, especially they'll benefit you in your first year of your career. If you want to do accounting or finance or auditing or taxation, but they will benefit you. So we were doing corporate governance, so we're going to recap a bit on that. We talked about director's report. We talked about also auditor's report. We talked about the rules and regulations that have to govern the company. So we're gonna recap on that. We don't want just to talk, go on, and whereas other people are left behind. So we're gonna recap on that and finish up our topic for today. So we're gonna go a little bit step back so that everyone should be on the same page. Okay. So, sorry about that. So let's do this. Let's try and see if we could remember some of the things that we learned last week. We're gonna just choose random things from the topic that we learned, that we talked about last week. What is a director? What is a director? A director, it's someone. Okay, I wanna just to write something here so that you could see. Yes. Okay. A director or directors are people that give direction to the company. They give what? Direction. Let's write it down. They direct, give, let me do this, the company direction. If you still remember that. And what else? And also that the ones who make major decisions, okay? They make major decisions. Sorry. Yes. Directors. They're the ones who make major decisions, and provided by the information that they get from the employees, which are the managers, the CEO, the financial management, they're the ones who provide much information to the directors, and the directors, what they do is they're the ones who come with major decisions, how the company may be profitable, how the company may grow. And just to remind you on something about directors. There are different kinds of directors. Okay, there are different types of directors. Let me choose a pen here. Uh, this. Yes. There are different types of directors. There is what we call an executive director, and there is a non-executive director. Executive. What is the difference between the two is this one is involved, this one is involved in daily basis, like he's there at the company, he's there doing, the daily routine, is always there like a CEO, is always there. And there is a non-executive director. A non-executive director is someone that comes sometimes there to maybe attend the meetings and go out. You see, and there is an independent one, whereby he doesn't have much relationship with the company. You see, so those are the different types of your directors. You see, so you have to know those things. You've got to know what is a director, what is the role of the director. The directors give the company decisions, directions, and they make major decisions. And remember, directors also, their responsibilities is to what? Is to make sure that they serve in the best interest of the company. I think we have to write that down. Let me write this one down so that we shouldn't forget this one. Okay. The responsibilities. Yes. Let's see. What are responsibilities of a director? Firstly, the responsibilities of a director is to make sure that he acts in good faith. Director must act in good faith. He must be trustworthy. Remember, this person he's holding the capital that is brought by the shareholders in the company. So he must act in good faith, in the best interest of the company. Best interest of the company. Best interest of the company. Also, he must be competent, not trading recklessly. He must be also competent, having necessary skills. He must be skilled, having required minimum requirement knowledge, skilled, and must have knowledge. So this is a summary about a director. So what we have learned about directors last week, you went through it. So I was just summarizing what is a director, what are directors, and their responsibilities, their duties. And remember, breach, if a director breach his uh, responsibilities, he'll be declared as delinquent or disqualified. Remember, a director must always be honest, act in the best interest of the company, and also there is a certain information that he must keep to confidential. It mustn't be just disclosed, you see. So the directors, they've got a huge, it means that the directors have got a huge responsibility upon themselves because they are the ones who are bringing profits, who are making the company to be profitable, you see. And on the other hand, they are the ones with, if they make good decisions about the company, they, they eventually, indirectly, it will attract more investors to come in and invest in that company. I hope you're together. Let's go to the next one. Shareholders. What are shareholders? Shareholders are the ones who bring capital. They are capital contributors. They come and buy a certain share of the company and they're given a share certificate. If you remember that. Remember, there are different types of forms of ownership. There is a sole proprietor, and there is a partnership, there is close corporation, and there is a private company, and there is a public company. So with the sole proprietor, you find that the owner is just one individual. But with the company, you find that the owners of the company are the shareholders, of which they buy a piece of share in that company, and they're given a share certificate, depending on what kind of shares they buy. Because we've got different kinds of shares. We've got something like preference shares, ordinary shares, you see, cumulative shares, you see, we've got also debentures, you see, we've got different kinds of shares. So in a company, when shares are issued, some of the shares, they have to have a voting right. They've got to have rights. So when shareholders or any individual or you go and maybe you want to buy shares in let's say ABC Holdings. You go and buy shares, and you buy these shares that have got a voting right, meaning that when there is a meeting or a dispute or something in the company, or maybe they want to take a decision on certain thing, there'll be a board meeting. There'll be a board meeting, or there'll be not a board meeting. I'm sorry about that. There'll be a meeting, a shareholders meeting, whereby they'll address the issue, and the shareholders who've got the voting rights will start to vote on behalf of the decision or against the decision. You see. So I hope I'm talking to the future accounting students. One day you'll experience such things once you're done with your career. It's very interesting. So shareholders are the ones who owns the business. You see, are the ones who owns the company. Sometimes you find that a shareholder could own maybe 1% of the company. Sometimes the shareholder will own maybe 0.5% of the company. Another one can own 80%. You see, those are the shareholders. And remember, shareholders also, they've got rights. They are the ones who appoint directors. They are the ones also who can dispute. You see, they are the ones also who can maybe they're entitled to dividends of the company. When the company makes profits and declare dividends, they're the ones who are entitled to those dividends. We spoke of auditors. Yes, we spoke also about auditors. auditors, remember, are the people who, if we just, break it down, it's like people who come to check if the work is done proper. An audit is like an inspector. You do your job, an inspector will come and to see if you have done your job proper. So that is the responsibility of an auditor. They come to check if the financial statements were prepared accurately, materially, and also they were prepared fair, that there's no misleading information for personal gain. Those are auditors, the duties of the auditors. They are responsible for that. So when it comes to big companies, they've got the audit committee, of which in that audit committee, it must be only non-executive directors. Remember that the aim that the auditor should be there is to prevent, we'll go through that. It's also in corporate governance. It's measures to control the company's finances, whereby there shouldn't be a situation, an accountant stealing money through misleading financial statements. So an auditor will come to see if the financial manager or the CA prepared the statements, the financial statements, accurately, without misleading or without manipulating anything. So that is the duty of the auditor. And also an auditor will give report. Remember, we talked about auditor's report, we talked also about the director's report, we talked about those things. An auditor will always give a report. So now we've got two types of auditors here. We've got two types, of which the other one is internal, sorry. And the other one is external. Wonderful. So an internal audit is the one who works for the company. He's the one who's always there working for the company. So an external one is the one that comes from the outside, independently so, coming to audit the company. Okay, we'll make an example so that you should understand. Here's a company. Let's call it maybe, what shall we say? Let's say this company, it's A, B, C Limited. Yes, it's just an example. This is our company. Now, this company will have an accountant. They'll have an accountant. They'll have an accountant. It will also have an auditor or auditors. You see. So what happened is, firstly, the books will go through a bookkeeper, people, the one who records transaction, or maybe from the till slip, the till slip will record everything, the transactions that are coming in, if it's a retail shop. So, but there'll be those ones down there who are recording transactions. Then from there, from the record of transactions, then an accountant will come and compile all those transactions and draw up what we call maybe an income statement, what we call it, statement of profit or loss, or statement of financial positions. Then he'll do those financial statements, he'll prepare them, then the auditor will come and audit what this guy has done. You see, what this guy has done. After auditing what this guy has done, according to law, the law says, according to Companies Act, that this company should be audited by the external auditors, not the ones who are working in this. So now, meaning that an external auditor, this guy here, this one, will come and audit this man, audit this ones. You see? Externally so. And if it's an individual, he has to audit the company for not more than 5 years. After 5 years, that individual, his time is over. Then another person who is an external auditor must come. But if it's a company that audits, that means that they have to change their auditors. If maybe their auditors were there for 5 years, after 5 years, then they must go and send another auditor to go and audit that company. Maybe this one, ABC Limited. So I hope you understand the situation of auditors and their role. And when an auditor comes, the external auditor, when he comes and audit the financial statements, then he will give a report how the financial statements were prepared. So I hope everything is it's getting clearer. We'll go backwards where it was just a recap. It was just a recap. So I want us to go back to what we're doing. Okay. So on Friday, we were talking about the examples of director's report. Remember, a director is like a steward. It's like a steward whereby, let's say here's a man, he has a family. Then he goes and stays overseas, and he asked this guy to say, can you please take over, look after my household? So meaning that this guy, who is a steward, must be faithful and he must do his job according to the way the owner of the house or of the home will desire his house to be run. And thereafter, he has to give a report. You cannot just run something that is not yours and you don't give a report. Then he has to give a report that this is what I've done, this is what's happening, and this is what happened to your house, this is what happens to your family, this is what happens to your business. You see? So that's what a director does. The director, after making those major decisions, and directing the company and making sure that the company doesn't go down, and trying all his best, he has to give a report. You see, there must be a report. In the report, he must state how the company is progressing, what were the hiccups, what is the plan for the company, because the big companies, for them to prosper, they must have a plan, they must have a budget plan. You see, so the example of director's report, the annual financial statements of the company are prepared on the going concern basis. The directors have reviewed the financial performance of the company as well as its longer term forecast adjusted performance. Remember, financial statements, it's something that can attract investors, and it can also chase away investors. So as they are prepared, the investors, when they look at the financial statements, they'll make their decisions whether they will buy shares in this company or whether they should sell their shares. They see that no, this company doesn't have direction, or they should have hope that this company is going somewhere. You see, based on the reasonable expectation that the company have adequacy of resources to continue in operational existence for the foreseeable future, nothing has come to the attention of the directors to indicate that the company will not remain a going concern. So I want to tell you something. There is two things that the company has to do each and every time, or let me say each year. If the company wants to dispose a greater percentage of their assets, or if maybe they want to maybe grant a loan to a director, you see, or maybe they want to increase the salaries of the directors or their benefits, they have what they call, there must be a test and liquid ratio that must be done. You see, a company, each and every company must go through that test and liquid ratio. And it must be always positive that the company, that means that test, it's to declare if the company is able to pay its debts, and also it can continue. I think those things you learn more about them also in your first year. But there's nothing difficult about that. If you want to ask questions about that, you can ask. We'll also open discussions, because this, I think, this topic is more of a theory. But the thing is, we want to wrap it up so that if you want to ask questions about corporate governance, about directors, shareholders, and auditors, you could ask, and so that it should be clarified. Okay. Approval. Okay, this is the example how a director's report looks like. The approval and preparation of the company's annual financial statement. The annual financial statements of the group are set out on pages. Remember, an annual financial statement is not just one page. It could be a lot and lot of pages, depending on the size of the company. You see, are set out on pages 2, and the financial statements of the company are set out on pages. You see, this is a nice example how a director's report looks like. You know, commenting about the financial statements, how they were prepared, and also it will also put the name of the auditor, the one who was auditing, or also maybe the company that was auditing the financial statements, and also that who approved the financial statements that they should be published. Internal control process in the company. This is very important. It's very important. I'm telling you, my accountants, my future accountants, without controls in life, life is a mess. Life without control, it's a mess. That's why there is this thing that they call damage control, whereby, hey, when things are messed up, that's why we want to do damage control. So, but in the company, there's what we call internal control. So I want to make examples. I want to take, our daily life things that we see as an example so that you should understand what we're talking about here, about internal control processes in the company. You see, in life, if you don't have controls in life, controls means like order, like a way of doing things, to prevent negativity to come in and spoil what you're doing. You see, that those are controls. You set controls in your life. If you don't set controls in your life, you're bound to fail. You're bound to fail. So even in the business, in the corporate world, you get controls. That's why they're called internal. Internal means in the company. You see, internal control processes whereby they are set to prevent theft, to prevent misconduct, to prevent a lot of things that can make the company to go down. There was a time whereby I think it was late last year, whereby the city of Johannesburg, the municipality, its account, it was hacked. Imagine, it was hacked. So that's why we need internal control processes to prevent that. You see, we don't wait for the situation to happen, but we set controls just in case if the situation might occur. You see, like for instance, if we knew that a disease like this will come, COVID-19, we'll make controls in a way that by the time when this disease comes, the company may be able to continue. But the thing is, we never saw this thing coming, so there were no controls regarding this COVID-19. That's why a lot of business suffered. They really suffered. You see, now I think I'm making this thing of internal control to be very, very simple so that you should understand how it goes. So internal control is to its objectives, okay, the essential objectives are economy, efficiency, and effectiveness of the operation, internal financial controls, you see, also compliance with applicable laws and regulations. This also is very important because there is a cost, there is what we call cost of non-compliance. A lot of companies can go down if they don't comply with the law. Hence, that's why you see, my fellow accountants, when next year, when you go to the university, you'll do what you call commercial law. It's that subject, it is important so that they should acknowledge you with this. They should acknowledge you with this. It's very important because if you can do something against the law, that it will lead the company to be sued. You see, so that is the objectives of internal control. You see that to see that we even the ones who are preparing the financial statements should comply with the law, and also there is control over financial statements and also confidentiality. So internal control processes in the companies, Kin 3 requires, okay, I know some are studying Kin 3, but I'll advise you that you should study according to the syllabus. You see, I know there is Kin 3, but there is also Kin 4. That's an updated one, but study according to the syllabus so that you should pass. But also, you can also study Kin 4 if you want to, for your own benefit. Kin 3 requires that the company maintains effective risk management and internal control framework that should include, okay, when it comes to this, some companies, what they do is, when it comes to this, they appoint here They appoint risk committee. That's what they do. They appoint risk committee. You see, to eliminate a lot of risk. It doesn't mean that there won't be any risk, but to avoid certain risk, you see, unnecessary risk. Clear accountability and responsibility between the roles of the board, its board committees, management and internal audit, as well as other assurance providers. Clear also the internal processes in the company, we are talking about that. Clear understanding of the risk management framework and risk management processes amongst all players. This is very important. Risk management processes. Because a company can't just take all risks that are coming across. You see, like you find sometimes as an individual, you'll hear on the internet, they say, come invest, come trade. You'll find that everyone is like, it's trading. I'm doing Forex, I'm trading, but they're losing money. And you find that there'll be that only one who succeed. You just wonder what's happening. So with companies, they don't gamble, they don't take chances. You see, that's why they go through these risk management processes. They check the risk, they do calculate, they take calculated risks. They don't just take any risks. The manner in which risk management and internal controls contribute and to improve the business performance. So these risks, they must be really thoroughly calculated, checked, and they test. Those risks, they'll be tested. And once they're tested and see if the company will survive. I can't take my company and take it to places whereby I know that there will be wars and soon my company will be blown away. You see, I have to calculate. You understand? Clarification regarding the value added by the respective roles. Okay. Let's go to an activity. Then to activity, this will be things that you have to do. Study the following auditor's report and answer the questions that follow. Audit opinion to the shareholders. In our opinion, the financial statements fairly present in all material. So this is a audit opinion to what, like, it will be written maybe at the end of the financial statements. In our opinion, the financial statements fairly present in all material respects the financial position of the company and the group at 30 June. This is the year end. It's an example. It's the year end of the company and results of the operations and cash flows for the year end. For the year then ended in accordance with IFRS and in the manner required by the Companies Act in South Africa. And they write also, it will be like maybe the chartered accountant will be maybe Smith and Sons, or maybe that's an auditor's company or whatever it is. Yes. Let's go to the next one. What is the purpose of an independent audit report and who is it addressed to? We spoke about this. The purpose to report on the company's financial records and to determine whether there is a fair presentation of facts and whether the policies are consistent with the previous year. And also it is addressed to shareholders, not only shareholders, also even stakeholders. I'm almost done. Okay. Explain why would you satisfy, explain why you would be satisfied with this audit opinion. The auditors have stated that they are satisfied with all aspects of the financial reporting by the directors. Remember, these auditors are independent. So they went through those financial statements. That's why they are satisfied. This is a standard report. And the standard cannot expect better fairly presented. No negativity comments reports. If the auditor had been dissatisfied about anything, he would have stated it here. Remember, the aim of a company having an also external auditor is that also investors should have confidence. They know that if an external auditor comes in and audit the books and gives an opinion, that means that they were prepared fairly, because there is a relationship between the company and internal auditor. It's like this. It's me, my dad, my mom here, my sister. My dad is he's a manager. I'm the boss. My mom here is an auditor. My sister is an accountant. And we see that the company is a little bit failing. Obviously, what we're going to do is we're going to manipulate the financial statements and present them as if like the company is doing well, so that you should invest in our own company. That's why external auditors are needed. They have to come and go through what is happening in our financial issues, thereafter and give an opinion that no, this company of this family is going down. You see, so that's, you see, the importance of the auditors, of the external auditors report. That's how it's so important. And also it has to comply with IFRS and also Companies Act. And if there's the irregularity, that company will be reported to IRBA. Our last slide for today. The auditor's report refers to the International Financial Reporting Standard, IFRS, explaining why auditors have to take IFRS into account in expressing their opinion. Requirements by auditing standards, as the IFRS sets standards for preparation of financial statements. This enables financial statements of different companies to be compared in South Africa and other countries. My fellow accountants, please study. I think on Wednesday we'll open up for question and answers, and we'll introduce another topic, because we have to engage. I can't be the only one talking here. I'm not the one writing. You're the one who is writing. So we must make sure that you understand. I think on Wednesday we'll make sure that you ask questions and you comment. I want to hear from you. And if you're not clear, we'll take it slowly and relaxed, and we'll try to make it very, very simple. You see, there's nothing like accounting is hard. It's not hard. So I hope you enjoy your week. So please, on Wednesday, come again, join these lessons, and don't forget, if you want to participate, go to this website, www.hellosmart.com, and you just create the clean